Welcome to the channel. My name is Brahim and this is literally breaking news. Dow rises 300 points to touch a record. Nasdaq sheds 2% as rotation out of tech continues. So that's a lot to take in. The Dow's up 300 points. 300 points is basically just less than 1%. And the Nasdaq sheds 2% as rotation out of tech continues. So with stocks, people sometimes go from value stocks to dividend stocks to growth stocks to different industries. Maybe they go to consumer staples and utilities to stay in safer things, or maybe they feel a little bit more bullish on the overall market and they go to consumer cyclicals, thinking people are going to spend their money and the economy is growing. So it looks like people are shunning away from tech, which the Nasdaq is. It's a tech index consisting of over 100 stocks. Anyway, the Dow Jones Industrial Average climbed on Monday as investors piled into the economic comeback plays after Senate approved of a new COVID stimulus package. Now, this is the third stimulus package I believe Americans are getting, which has been rumoured about 1.4k, I believe, might be wrong. While a continuous sell-off in high-flying tech shares puts pressure on the S&P 500. Now, if we think of tech and you think of a figure that's very famous and notable, I would probably say Cathie Wood. So if you're looking at her ETFs, they're probably getting hit the hardest at this current moment. The absolute hardest. She's invested in tech. She's not invested in Walmart. She's invested in innovation, fintech. Literally, tech. That's what she's invested in. The blue chip benchmark gained 480 points after jumping 650 points to hit an intraday record. The S&P 500 erased a 1% gain to trade over 0.1% lower, dragged by tech. The Nasdaq Composite slid 2% in volatile trading as Apple dropped 3.8% and Tesla fell 5.5%. Now, we know Tesla is one of Cathie Wood's biggest holdings. She absolutely loves the company. Now, let's look at Tesla's stock price over the last few days. Well, not really the last few days, the last few weeks. If you go to Tesla on the 1 month chart, you can see it's gone down from $849.46 down to now $563. That's down 33%. 1/3 of that stock gone. Now, Tesla's business hasn't changed. No. The only thing that's changing is the stock price. Tesla's still selling cars. It's still going to sell cars at more affordable values. But even the year to date, it's down 22%. That's 3 months. Less than 3 months. 2 months, it's down. The Senate passed a $1.9 trillion economic relief and stimulus bill on Saturday. Now, if you know about GDP and debt, what's important? That the economy is making stuff, being productive, bringing value, while actually being able to monitor the debt and not make sure the debt is like this. Sorry if the transition's a bit weird, my phone died, I just had to get another one to record, so the camera quality and audio might be different. Anyway, so like I was saying, $1.9 trillion is a lot considering America's already in a lot of debt. 40% of US Treasury bills, so all the dollars, 40% of it was printed last year. 40%! That's a ridiculous amount of printing that's been done by Jerome Powell. Ridiculous. Paving the way for extensions to unemployment benefits, another round of stimulus checks, and aid to state and local governments. Now, regarding the stimulus checks, they're supposed to be for paying your rent, for paying food, but how long this pandemic's gone over for over a year, and for there to only be 3 stimulus checks, America really didn't look after their people. They really could have made sure that everyone had money so they were secure. They could have found smart alternatives and budget, maybe cut costs from military or other ways, but they didn't do that. And they've given them a third, well, in the process, they've given them a third one. Now, other places like Canada and for myself in the UK, they dealt with it so much better in terms of giving everyone monthly paychecks at a reduced rate of 80% if you was not able to work. Not because you chose not to work, because the government chose to close your industry or business down and you couldn't physically work because of the pandemic. You was receiving 80% of your salary, which has been useful to keep people not becoming in debt or behind on their rent or struggling to find their next meal. But it looks like America didn't really do that for their people. The Democrat-controlled House is expected to pass the bill later this week. President Joe Biden is expected to sign it into law before unemployment aid programs expire on the 14th of March. A lot of people, and I mean a lot of people, have been using their stimulus checks to invest. And currently, the biggest thing people are investing in is GME, GameStop, for the short squeeze. So there will be a lot of people flooding in their stimulus checks straight into GameStop. And funny enough, March 14th is before March 19th. Meanwhile, the Centers of Disease Control and Prevention said Monday, people who's fully vaccinated against COVID-19 can meet safely indoors without masks, further boosting reopening hopes. The positive news boosted stocks banking on a strong economic recovery. Disney shares added more than 5% after California eased COVID rules, paving the way for Disneyland to reopen at a limited basis in April. Next year, Disneyland can reopen. Disney's had so many different revenues where they get their money from. And recently they had Disney Plus, which has been killing it streamer-wise. American Airlines jumped 4% while United Airlines popped 6%. Target rose 2.7%. More stimulus could provide a big lift to the stock market, but it may come with some bumps, says Lindsay Bell, Chief Investment Strategist at Ali Invest. Runaway inflation worries have been stumbling blocks for stocks as of late. Because of this, there could be more market weakness ahead as investors grapple with shorts and long-term effects of stimulus. High-flying stocks like tech and the stay-at-home stocks may be hit the hardest. A primary candidate to be hit by this? Cathie Wood. Her ETFs and all her funds are tech-orientated. Stay-at-home stocks may be hit the hardest. Stay-at-home, you're talking your Google, your Facebook, any sort of things that's listed in the Nasdaq, basically. So the Nasdaq might not be the best place to put your money in for the current being in the short term. Long term, maybe. Short term, no. Tech stocks remain the biggest losers on Monday, continuing the trend for the last few weeks. High growth stocks, which were among the best performers last year, are particularly vulnerable as higher rates reduce the value of future cash flows. Apple has fallen nearly 15% in the past month, while Tesla has dropped more than 35% in that period. Pandemic better Zoom videos and Peloton have tumbled 24 and 30% over the past month. Sentiment got a boost earlier Monday after hedge fund manager David Tepper said the recent sharp rise in rates is likely over and it's hard to be bearish on the stocks right now. Basically, I think rates have temporarily made most of the move and should be more stable in the next few months, which makes it safer to be in stocks for now. Tepper told CNBC Joe Kernan, who shared the comments on Squawk Box. The benchmark 10-year yield has risen sharply in recent weeks in anticipation of more stimulus on top of booming economic recovery. The 10-year Treasury yield rose 4 basis points to 1.6% Monday. The bench rate started the calendar year below the 1% mark. Tepper believes the sell-off in Treasuries that has driven rates higher is likely over as big foreign buyers like Japan are poised to come in. He also said bellwether stocks like Amazon are starting to look attractive after the pullback. For March, the Dow Industrial leverage more to reopening is up 3.1%, while the Nasdaq Composite is off by 2.1%. Meanwhile, the broader S&P 500 is up 0.7%. The S&P 500 remains less than 3% from all-time highs. We see higher rates largely as a function of earlier and stronger than expected economic recovery and supportive of a positive equity outlook. Dubravko Lakos Bujas, or Bujas, JP Morgan chief US equity strategist, said in a note. Now, if we look at the Dow Jones, in the past month, you can still see it's up by a total of 1.36% or 426 basis points. Year to date, it's up 5.22%, 1,578 basis points. Past year, it's up an entire 33.34%, 7,951 basis points. Does the Dow Jones look like it's going any time to become bearish? Not really, not really. Whereas if we look at the Nasdaq, let's look at the Nasdaq. 1 day it's down, 5 days it's down a total of 7.1%. In a 1 month, you can see it's down 10.14%. 6 months it's up by 7.93%. Year to date it's down a total of 3.12%. And in a 1 year chart, you can see it's recovered from the last year, March, where we had the COVID pandemic starting. It's up 54%. So it's up a lot more than the Dow Jones. The Dow Jones was up 33%, whereas this is up 54%, which is kind of a lot. At the peak, of course, it's gone down about 10%. Is this a good buy opportunity? Maybe. Is there more bloodshed to come? Also possible. If you enjoyed this video, please leave a like. I'm trying to hit 1,000 subscribers by the end of the year. That'll be amazing if I could do that. And are you invested in any Nasdaq stocks? Put them down in the comment section below.